The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
Hello, this is Alistair McLeod on behalf of Gold Money, and with me on the line from London, fleeting visit I have to say, is David Baker of Baker Steel. Baker Steel are portfolio managers specialising in natural resources and particularly precious metals. Welcome to this podcast, David.
Thank you.
Now, recently you were quoted, I think I'm right in saying, in the Australian Financial Review that it would be better for companies, gold mining companies, to pay their dividends in gold or at a rate which relates to gold, because otherwise there is a sort of a disconnect, perhaps, between what investors perceive they're investing in, and I suppose at the other end, though I don't think you mentioned this, if you're actually on the ground trying to manage the cash flow in a mine, you tend to think just purely in terms of dollars. So I think this is a very interesting topic because it must be at the heart of the underperformance of mining shares compared with past bull markets at this stage. Would you think that's a sort of fair summary of how you see it?
Yeah, no, I think there's a big big disparity between the gold shares and gold, and this is a thing that's obviously causing a lot of grief, not only for investors like ourselves, but the companies, like Peter Monk has mentioned, that this is the key thing that they have to try and resolve. And our feeling is that the mining companies are confusing investors because, they have a lot of ounces in the ground, or they tell the market that they've got all these ounces. And then they confuse people by telling them that they're producing dollars instead of ounces. So our view is that we're using the wrong denominator when we're looking at the mining companies. And so mining companies should be communicating to us in gold. And then we can basically get a better understanding in just basically what these companies are actually doing and how they're performing.
That's interesting because it wasn't all that long ago that investor pressure stopped the mines from selling their production forward and destroying the gold price. Sorry.
In a disinflationary environment, I think it's the right thing to basically forward sell gold, and that's what was happening in the 1990s. That the gold price was falling and the dollar was rising, and so it made every sense to sell your gold as quickly as you could for dollars. In fact, it made a lot of sense to sell gold that you'd yet to mine for dollars today or at that point in time, because the dollar was rising and gold was falling, and that's why that trend became very, very good, and that's why a lot of people got onto the bandwagon. And at the bottom of the market, there was over 3,300 tons of gold forward sold, which was basically doing that trade, selling gold and buying the dollar. Now we're in a different environment. Now we're in an environment where there's higher inflation and the gold price is rising at about, 15% per annum, and costs are rising as well. But what's happening is that the gold is rising and the dollar is falling. So that trade should be reversed now. So instead of mining companies getting the stuff out of the ground very quickly and converting it into dollars, which then depreciate, the mining companies should be taking the gold and then keeping it in gold. They've obviously got to meet all their costs and settle those in dollars, but they should be keeping any margin basically in gold, and then that basically gives them a currency. Because if they then go and find a new gold mine, and the costs have been rising, instead of having dollars which have depreciated on their balance sheet, they've got gold which they can convert back into dollars. So it basically maintains their purchasing power.
Should we in this differentiate between exploration companies who basically are cash starved and need the cash flow, and therefore in the early stages of production have a huge incentive to sell their gold forward, and more established gold mines who already have a cash flow and who can actually pay out dividends in any form that they like.
Well, I think that's right. I mean, what we want to do is to get a connect between what's in the ground and what we get as shareholders. So at the moment, if a mining company goes and finds another 1 million ounces, the market says, well, so what? I'm not getting anything for that. If we basically look at this project in gold, and then the mining company tells us that we're going to get, say, 2.5% or 5% of what they find, they're going to dividend that out in terms of dividends. So, the mining company will say that every year we'll pay out 2.5% or 5%. So it's a bit like a royalty that comes back to us. Then if they go and find another 1 million ounces, then the market will be able to pay. They'll understand how they can pay for that they will then get something back for it.
Right, so what we're essentially saying is we need to tie down in the investor's mind the relationship between, not only gold production, but also the reserves, the whole, if you like, enterprise value of the mining company in their mind in gold terms, rather than thinking it, rather than just thinking in dollars.
Yeah, we need to get the connect between what's in the ground and what comes back to shareholders. And at the moment, that's been lost. And what's happening is that because the gold mining companies aren't giving investors what they want, and we know what investors want because we can see that the two very successful parts of the market at the moment, the ETFs are very successful. We know people want physical gold. And the other area in the market that's very successful is the royalty companies. So companies who basically can protect their margin, or the market perceives that they can protect their margin. Because when we look at a gold company over the last few years, people say, well, actually, the costs of production are going up in dollar terms, and there's going to be margin squeeze because the people say, well, the gold price has peaked, and if the gold price has peaked and the gold price and the costs carry on going up, we're going to see a margin squeeze. What we're actually saying is if we look at the costs not in dollars but in gold terms, the costs are fairly steady. And if you take the typical gold mine, it generally costs, say, 10% of the gold in the ground to build the mine. It's going to take between 40, 45, 50% of the gold to as an operating cost to basically get the gold out of the ground. And about 15% of the gold will go to taxes, and maybe another 5 to 10% will go in sustaining capital, and the balance is basically what's coming back to shareholders, and that stays fairly constant over a period. There's so what we're arguing is we're using the wrong denominator. When we look at dollars, when we look at a gold company in dollars, we're confusing investors, and so investors are losing this margin. There is a good margin or a reasonable margin in all these gold companies.
Yeah,
but the market's not paying for it because it doesn't understand the consistency of the gold, and that's what we're saying, that we're communicating, or the mining companies are communicating in the wrong currency.
Yeah, I get that point, and I think it's very, very well made. I just want to pick up on something you said, and in fact, you're echoing something in the article that we were referring to. I'll just read a little paragraph from it. Analysts are forecasting higher costs, but at the same time forecasting lower gold prices over the longer term, which is what you said. I must admit, I haven't been exposed to many analysts expecting lower gold prices. I mean, are these sort of industry sources just sort of thinking there's a cycle of commodity behavior and they're looking ahead that way, or? Well,
this is consensus numbers. Basically, if you look at forward projections on the gold price, that basically they'll have them going up maybe next year and, fairly steady the year after. And then they'll have them coming down to some long-term average, which is probably around $1,200, $1,300 an ounce. Now, that when you put all that into the equation, that basically means that the market's not going to be paying for those ounces in 2 or 3 years' time, because they're going to say there's no margin, and that's why the market, we believe, partly has been derated.
Yeah, but it doesn't actually make an awful lot of sense, because the assumption behind it must be that the dollar is a constant, but it's not. The dollar is being printed at a fantastically accelerating rate, and the idea that you can actually look forward to gold prices in 3-4 years' time and just say it's a cyclical thing assumes that what's happening to the printing presses, if you like, for paper currency at the moment is going to, some miraculously cease, and we're all going to be sailing out into the nice calm waters afterwards. This is an assumption which I would have thought should have been severely shaken over the last year or two.
No, it's this is what the market's saying. The market is just not willing to pay for these ounces going forward. So that's what we think. If we change the denominator and we say, look, this.
I hear this, but I just want to sort of, you say the market. I mean, are we talking about fund managers when we talk about the market? Because ultimately, I think what these companies must be interested in is the ability to raise funds in order to expand their businesses. So, I mean, you're very much an intermediary as a specialist between these companies and the fund managers, as it were, and you're also, a fund manager yourself. Is it the fund managers who are looking at this sort of mechanistic model? Is that what we mean by the market?
Well, the market is a collection, whether it's the generalists or the big pension funds or other investors. It's basically the collection of all the players in the market. So it's a generalization, but this is how we're explaining the derating of gold shares, that we think that the market is not valuing those future ounces. And so what we want to do is to basically look at this sector differently, present the sector differently, present these companies differently, and basically get rid of this anomaly, because we agree, like you, that there's going to be, that the currencies, the fiat currencies of the world are going to be decimated, and gold is going to be the last man standing.
Yes, exactly.
So we think that we should concentrate on the gold. And if we give the investors a linkage between what's in the ground and what they're going to get back in terms of a royalty or dividend on that gold, then there's more chance that the gold companies will get re-rated. If you look at it at the moment, if you're holding gold, why would you sell your gold to buy a gold equity when you know that basically the gold company will dig up the gold from the ground and then give you back dollars?
Yeah, I think that's right. And I think what you're doing is you're really hitting the nub of the problem there. And that is, compared with previous bull markets, we've now got ETFs and, dare I say it, services like gold money, giving an alternative to that sort of, to investing in gold mines. But I think in a broader sense, there is actually, and we need to remind ourselves of this outside the industry, there is really not much bullishness about gold. They just don't seem to understand what is going on. It's not so much what is going on with gold, but what's actually happening with paper money, which is reflected in the gold price, if you like. And the average level of portfolio exposure is still abysmally low compared with the level of portfolio insurance that people would have sought in the past. Now, this must be quite a problem for you expanding your business as a fund manager specializing in precious metals. How do you see the, if you like, that aspect of the psychology in the market? What do the portfolio managers generally think? Well,
I think probably people hope or people expect that the governments, will resolve things. I mean, I find that hard to believe, honestly, because the things that I read, I'm sure I read the same sources that you do, is that, I think that we're on a bit of a road to ruin here, and investors should be protecting their wealth. But, our biggest challenge is the gold equities. Our business really is on the gold equities, and we need to basically get these gold equities trading higher. And so what we're looking at are ways that we can get what we want, and we can. And our view is that our strategy of basically reporting in gold, holding gold on the balance sheet, and paying a dividend to investors in gold, we think can't be any worse than the current status quo. And you can see it in the market at the moment, the derating of the gold shares. The mining companies are being starved of cash, so then they're being forced to go to the banks, which are basically charging exorbitant fees, exorbitant conditions in terms of forward selling and other things. And it's really the mining companies have been taken like lambs to the slaughter. And that makes the situation even worse because we don't get what we want at all. I mean, we just don't want to buy these things. So what we're doing is we're going back to the mining companies that we own, and we're basically saying this is what we want. You know, if you want to build a new gold mine, if you need some money, we're happy to basically supply some money, but it has to be on these terms. And we are getting a lot of interest. You know, we're being very proactive on how we're managing our money here at Baker Steel, and we're going out and we've got a number of companies where we're in close dialogue and the final stages of basically bringing a few of these things to market, and then it will basically be proof in the pudding, you know, if our strategy works. But
well, of course, I think the other trouble, David, is that unless you do succeed, then Western, if I can call non-Asian production of gold is going to decline quite seriously because it is getting starved of capital, as I understand it. And the other alternative is that it forces these mines into the hands of the Chinese, who've got very, very deep pockets and are quite happy to buy up production.
Well, the Chinese are buying production. You know, there is still finance available. Don't get me wrong. The banks are giving finance, so mines, you know, will get built. The problem is that we think that's to the detriment of equity holders. You know, you'd have thought that in a high inflation environment, using debt would be the right way to basically increase the ounces that come back to shareholders. Well, it doesn't work because when the banks basically say, there's an example in Australia the other day, a mining company went to borrow $50 million. But to borrow that $50 million, it had to forward sell $200 million worth of gold.
Yeah.
So a ratio of, I think it was over $300 million worth of gold. It was 200,000 ounces of gold, so about 300,000 ounces of gold. So it's about a ratio of 6 to 1, something like that. It's ridiculous.
Yes.
Ridiculous. And that in a high inflation environment basically means that in 1 year, if the gold price is going up at 15% per annum, which it has been doing, and carries on going at that, in 1 year, basically, the cost of that debt could be over 100%. I mean, It's just ridiculous.
No, it is. It's crazy. I quite agree. I think one of the nice things, perhaps, about investing in physical ETFs and alternatives such as gold money is that you don't have political risk. How do you see political risk in gold mines? Do you think it's over-egged, or do you think that the gold mines have probably got to work very hard to ensure that shareholders are compensated for that little bit of extra risk? How do you see that? Well,
there is obviously political risk, and the political risk has been increasing. But I think a lot of it is because the mining companies basically say, well, their operating costs or their cost of production is $500 an ounce, but then they forget to tell everyone about all their other costs. So the average cost of production, I think that GFS basically said this morning, something like 1,150, you know. So the governments who are basically looking at, you know, sources of revenue think that the gold companies are a cash cow and that they want to increase their take. So I think there's a bit of skullduggery going on here, and the mining companies aren't doing themselves many favours in how they communicate in that respect. But there is greater political risk, but that's why we run a diversified portfolio, and you can diversify part of that risk through buying numerous companies around the world. So that's how we try and cope with it. But you know, a lot of that risk is now factored into the market because of the valuations of these companies.
Yeah, I think it's a very fair point. And I would add from my own experience of previous bull markets in gold that for investors, you can get enormous gearing in gold mines. And you can, depending on the gold mine, you can more or less set the level of gearing that you feel comfortable with. So it is actually, gold mines can be a very, very flexible way of investing. So, well, anyway, David, thank you very much indeed for taking time out to talk to us. If our listeners want to find out a bit more about Baker Steel, how do they do so?
Well, they can contact us through our website, which is www.bakersteelcap.com. and we have offices in both London and Sydney, and they're quite easy to find on the web.
Thank you very much indeed.
Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.